Good morning and welcome to Tuesday's morning market wrap. I'm Greg McKenna and it's a little after 9 o'clock. Kind of a boring night last night really. Stocks didn't do too much. They were down early, but the Dow and S&P managed to claw back into the black. In Europe, stocks were higher, although the FTSE was knocked lower by a minus. Really what's happened is that Chinese data yesterday, 6.9% year on year for the release of GDP, beat by 0.1%. My colleague David Scutt at Business Insider, when we did a quick Twitter guesstimate of what the data was going to be, said that he thought it had beat by 0.1% because that's what all the other beats have been recently. Now, he was spot on the money. Now that suggests to you there is some management of what's actually happening when it comes to data releases from China. And that 6.9%, although the slowest in years, is actually, when you do a quarter-on-quarter basis, the way that we'd normally report it in Australia, it's growing at the same pace as it did this time last year. Now that completely belies any sense that the markets have and that other indicators suggest that China is growing nowhere near its official 7% rate. So while stocks were happy that they didn't have another excuse to get flogged and a red rag to the bears, what's happened overnight is that commodities have essentially said, no, we don't believe you. And so we've seen copper down at 236.8 in pound terms, and that's down about 2%. We've seen the front contract of NYMEX crude get absolutely smashed down to 45.89, and we've seen base metals overall fall. The CRB commodity index is also lower, and so what you've got is this dichotomy of approaches between what's happened with stocks, which is kind of like a little bit of a relief trade, right? We don't have another reason to sell, and what you've got in commodities, which is dag nabbit, don't believe those numbers, the globe is slowing. And one of the big major investment banks in the US has come out and said that just this morning that growth is going to continue to slow across the world. It certainly looks that way. So that's meant that the Aussie is under a little bit of pressure, and we might have a quick around the grounds here for the Aussie and some other markets. So where's my Aussie chart? What we've got here is we've seen this little breakdown yesterday. So we've had a nice little kind of double top here, uptrend from September, a break above rejection. We're a little bit higher this morning at 72.50, but my normal, what would you call it? My normal chart would, oh bugger. My normal, sorry about that. My normal chart, trading system, I should say, would suggest that we're going into this sort of zone between these two moving averages. So we'll keep an eye on that one. While I'm here, the price of oil rally, rejection, and is now lower again. So nice little uptrend line. Of course, we had this box. You know, you can draw trend lines wherever you want to draw them. You could arguably draw it here, and then it's going to go through there, so it doesn't mean anything. But people do tend to look at trend lines, and clearly somebody's watching this one. You know, bottom, 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 break, break, test, test, rejection, lower. So now you'd argue probably that the price of oil is going to head back to this 45.68 region, somewhere there, and we'll see how that goes. And it looks like I'm still sharing my. No, I'm not sharing my screen. Well, that's suboptimal, so you couldn't see that. This is going well this morning. Let's just go back to the charts. And I've closed it again. No, I haven't. Righto. So let me, goodness me, what a day. What a day. Right, let's try again. All right, so this is the price of oil. Uptrend, broken, broken, broken. This is the key level, 45.64. Part of oil's movement last night was that OPEC's asked Iran to stop pumping out so much oil. Now that's a red rag to a bull, and it's no surprise, I guess, that oil has fallen and fallen so far. But we'll have to see how it plays out. If it was to take out that low, then you could see a significant, another couple of buck move lower. If we have I think we've had a look at the Aussie. So if we then have a look at, we'll just quickly have a look at the Aussie again. This is not one of my best ones, is it? That looks biased back to me into this 72 region. My normal system is I look at my 2 moving averages, I look at the price action in terms of trend lines and those sort of things, and then I look at what's going on in the MACD. And that suggests to me that Aussie needs to test a little bit lower before it goes higher. In terms of another one to watch today is the ASX 200. It went nowhere last night, largely because stocks didn't go anywhere anyway. But what we've got now is we've got this nice little trend line that we need to watch. The financial services inquiry is out this morning in about 10 minutes, which is partly why I'm stuttering and stammering and carrying on like a clown this morning. It's because I need to go and write some stuff about that. And I'm thinking about potentially what the impact could be on the majors. Now, I guess to a certain extent, I think that APRA has already been acting as though the things that Murray suggested for banks are going to be implemented. So to that extent, most of the news should be baked into the cake of the banks. And if it's baked into the cake of the banks, then it's baked into the cake of the market. But we'll have to wait and see. We'll know in a little while. Elsewhere, the key things, I guess, are that we really don't have any decent catalysts for a while now. Fed speakers, there's a civil war in the Fed still going on. Last night we got news that from Milan that that Bill Dudley, who's the New York Fed president and close to the market, said it's too early to think about rate rises because of concerns offshore. But his colleague from San Francisco, Fed President John Williams, told Bloomberg TV that it's the time to start raising rates is near. Now, where the US economy is now is probably completely inconsistent with 0% interest rates. And I strongly believe, as you know, I strongly believe that the Fed should have been raising for no other reason than if they're inconsistent, you get them up to 0.75 or you get them up to 1%, you can drop them again if the economy needs. If you're at 0, then you're just going to have to throw QE at the market again. And really, does that help anybody? Does that help business? But the problem you've got, and one of the reasons why I thought interest rates should have been rising, is you've got really strong employment, which, even with the slowdown, we're in the stabilization phase, not the growth phase. And then last night, the National Association of Home Builders released their index, which was the highest in years. They haven't been more confident since the housing boom before the GFC. So you are getting some real interesting parts of the economy, going gangbusters, I guess. So anyway, the debate about the Fed continues, and increasingly it's looking like they're going to have to do this. They're going to have this battle in public, which is no good. Which leads me to an article I saw on the FT this morning, which is worth a look. It's in 20 seconds at Business Insider, and I'm about to put a link to it on my own website. So in the old days, pre-QE, central banks used to be the dampeners of volatility. Not anymore. We all know that. We're all traders. So what we've seen is that there's this amazing feedback loop between what the Fed's going to do or what central banks do and what markets do, and then what markets do therefore impact on what central banks do. We've seen that with conditions abroad comment from the September meeting, or we've seen what's happened in emerging markets since and that kind of stuff. But I really like what Elaine Moore said. She said the bind between markets and central banks is beginning to resemble the Ouroboros, an ancient Greek symbol for eternity that depicted a serpent swallowing its own tail. That's a nice way of saying something's disappearing up its own. Anyway, eternity may be stretching it, but the volatility caused by markets watching central banks watching markets is not over yet, Elaine Moore said. And I have to agree 100%. So, we haven't done much in terms of stocks for the last day or so. We'll have to wait and see what happens. IBM's result was terrible. Crude bears watching. It'll impact on the Aussie and sentiment about risk assets. The emerging market rally stalled a little bit yesterday. The Malaysian ringgit was down over 1%, so we're going to keep an eye on there. There's lots of little fractures in the structure at the moment, so just bears watching. But overall, there's no real catalyst. We've got, right at the end of the week, we've got these flash PMIs, so that's a dangerous one. But as it stands at the moment, just trade your ranges. That's what I'm doing. And you know, in those terms, oil, Aussie, and the ASX 200 are probably three of my favourite. Let me just, gee whiz, it's a shocker today. Three of my favourite markets just at the moment. Also, euro dollar I think is heading low, maybe 111.50, something like that. Maybe 112. Obviously we're at 113.27, so 112.50, then 111.50. And the S&P might be starting to run into resistance here at this 2040, 2050 region if it gets there. So that's it for me. Have a great day. Watch out for the SFI and its impact on the local market. It could also impact sentiment for the Aussie dollar. But overall, I've lost my... There we go. Overall, it's going to be a pretty boring day. If it wasn't for the SFI, I think I'd take the day off and go have a surf. But anyway, that's it from me, Greg McKenna. I'll see you tomorrow. You can catch me on Twitter at Gregory McKenna. You can always catch me at Business Australia, Business Insider Australia, and you can always catch me at my own website, gregmckenna.com.au. Have a great day. I'm going to be quiet now. Stop mumbling, and I'm not going to trade today based on this. Have a good one. Bye-bye.